Greetings. This is Eric, founder and CEO of Cubicle Investing, cubicleinvesting.com. Some folks will often ask, why Cubicle Investing? Well, I actually learned how to invest, particularly trade options, while working in my cubicle as a computer scientist. So I started in my cubicle. I actually got into the real estate game while working in my cubicle as well. So decided that it made sense to call uh, my company, my LLC, Cubicle Investing, right? So, nevertheless, so my passion is trading options. So, I want to talk about some options trades that I put on recently. Have not made any YouTube videos in quite some time, so figured I would start in 2022 making some videos regarding my options trading. And also, if you guys are interested in learning how to trade options, you can certainly visit my website at cubicleinvesting.com, or you can send me an email, info@cubicleinvesting.com. All right, so some of you guys are probably aware that the minutes from the Federal Reserve Policy, or the FOMC, Federal Open Market Committee meeting that was held in December, those minutes from that meeting came out this past week, actually January the 5th, regarding the Federal Reserve's desire or intent to raise the interest rates this year, and also their intention to reduce their balance sheet, right? Meaning that they're going to pull back on buying bonds and also mortgage-backed securities, right? So the minutes, so the sentiment or the tone from those meetings was taken as a hawkish sentiment by the market. As a result, the market sold off in the later half of Wednesday on January the 5th, during the trading session, right? So we take a look at the the daily chart, a daily chart of the S&P 500, ticker symbol SPX. We can see that on January the 5th, the market opened around roughly 47.87 and some change. It pretty much traded sideways, and when the news of the Federal Reserve's December policy meetings minutes came out, right? That's a mouthful. The market reacted negatively, and as we can see here, the market sold off, right? So as a result, when these kind of sell-offs take place, I like to look for underlines, and the underline can be, when I say underline, underline can encompass, underline encompasses a stock, a ETF, exchange traded fund, or it could be an index, right? So it can be either one of those three financial instruments, right? But normally I look for stocks, right? So when the market sells off, like it did this past Wednesday, I like to look for stocks that pretty much hold their position rather, they're rather steady, or rather neutral and reacting to the sell-off of a market. So what do I mean by that? So if we look at, for example, the underlying MU Micron, right? Look at the same daily chart. If we look at how it reacted to the market sell-off on Wednesday, it dropped from a high of $98 and some change down to roughly $94 and some change. So a little over a 4-point move. But to me, that conveyed that buyers weren't really interested in taking profits or selling their shares of MU stock, because they are expecting more growth from this particular company, right? And so as we can see here, the stock did sell off in conjunction with the market, but nevertheless, on the next trading session that following Thursday, MU opened up, and so did the market as well. It opened up, and it has been somewhat volatile, but nevertheless, it's been holding steady in spite of the fact that there's some volatility in the market ever since those Federal Reserve meeting minutes came out. And so what I decided to do was I decided to put on a trade, looking at where over the last five days, where has MU been given support. And so that support has been around that support area or demand area, demand zone, if you will, has been around the price point of around $95 and $93 and some change. So $93 and some change has been the support area for MU. So I decided to put on a trade on MU where I sold a bull put credit spread, right? So a bull put credit spread is basically you're bullish, right? So you are anticipating that the price of the underlying, and the price of the underlying is conveyed by this circle here. So you are anticipating that the price of the underlying is going to stay above the short strike in which you sold. So I sold the 91 put option, and I bought the 89 put option, right? So that creates a spread. So this here is a $2 wide spread. So it's a difference between 91 and 89, right? And I sold basically 10 contracts of this bull put credit spread on MU. The expiration date is January the 14th. So that's 6 days from today. And again, the reason why I decided to put this trade on, or why I decided to actually sell the 91 option, is because, again, of what I said regarding the that support area. So that support area is roughly around, in this case, the $93.50 price point. And so going below that, I feel like I'm safe, so I feel like I'm safe until, I feel like my short option contract, the one that I sold, will be out of the money, meaning that the price of MU will not drop below my short strike of 91 come January the 14th. All right, so I got 6 days until this trade expires, so we'll see what happens. I'll come back and I'll share with you guys the results of this particular trade. All right, so I'm back. So as I mentioned before, I said I would come back to share the trade results with you guys on this MU trade. So let me move myself out of the way here. So today is the expiration date of this particular trade that I had on. So if you recall, I sold a credit spread on the put side, right? I sold a 91 put option, and I bought a 91 put option, which creates a spread, right? So the spread is the difference between the strike prices. So I got a 91, I got an 89. The differential is $2, right, or 2. An option contract controls 100 shares of the underlying. The underlying in this case is MU, right? So I multiply 2 times 100, which gives you $200, right? But I sold 10 contracts on this spread, and so on the platform you can sell as many contracts as your account balance allows. All right, so here you see the word quantity, right? So if I click to the right, you'll see the order value over here increase, right? So I'm clicking to the right. So I sold 10 contracts of this credit spread, this put credit spread on MU, and I took in the credit of $290. Now, what I normally do 99% of the time is that I will close the trade out early. Why is that? Because the less time you are in a trade, the higher the probability of you walking away with the credit in which you receive for selling your credit spread, right? So I took in a credit of $290 on this spread, on this trade, and I closed out on Wednesday, which was 2 days prior to the day, and I walked away with $277, right? So let's look out. Let's look out. Let's look at the breakdown of this particular trade, right? So I got in on 6th January, right? I sold 10 contracts of a $2 wide put credit spread, right? My capital, the capital that was required to sell this particular trade or to implement this particular trade was $2,000. So that was the risk that I had on for this particular trade. I took in the credit of $290, right? Which means that you actually subtract the $290 from the $2,000, right? And so again, the $2,000 comes from the fact that it was a $2 wide credit spread. Every option contract controls 100 shares of the underlying. The underlying in this case is MU, so that's 2 times 100 is 200, and then I sold 10 contracts, right? Which puts us at $2,000. So, but then you take in a credit for selling the spread, and so you subtract the credit that you receive from the risk, and that gives you your actual risk, right? So my actual risk, or the actual capital, the amount of money that was required to put on this particular trade, was $1710, right? So now the expiration date was January 14th, but I closed it out early, 2 days early, and I walked away with $277, right? So when you look at the return on capital, the capital that I invested or that was required for this trade was $1710. I walked away with $277. So when you do the math, the return on capital was a little over 16%. Now, think about that. So I put the trade on January the 6th, and 6 days later, I'm closing the trade out for a 16.2% return. Right, so roughly, for roughly 1 week, right? So now, if we annualize that, right? If you look at that from an annualized perspective, so there's 52 weeks in a year. So you look at 16 times 52, that gives you 832. So essentially, if you look at this trade from an annualized perspective, this is a 832% return on this one particular trade, looking at it from an annualized perspective. So that's the power of options. I mean, you don't have to actually buy stock to make money, right? As long as you understand how to trade options, and also it doesn't require, a large amount of capital, right? So, once you learn how to trade these options, you can make these kind of returns in a short period of time. So if you're interested in learning how to trade options, go to my website at cubicleinvesting.com. Scroll down until you see what you see here on the screen. Put in your name, email address, click on get my free ebook. That takes you to another page. Scroll down to the bottom of that page, and you'll be able to download my free ebook that teaches you the basics of options trading. And in addition to that, you will start receiving my weekly newsletter that comes out every Monday at around 10 a.m. Eastern Standard Time, where I'm always talking about, giving you guys investing ideas in the stock market as well as the crypto market. And I just give really good information about, the world of finance and investing in general.